Inflation is still a hot topic this afternoon, and some stakeholders in the banking sector say the high inflation rate could impact negatively on interest rates, affecting the loan books of lenders. Data released by the Ghana Statistical Service this week showed inflation rate increased to 23.6%, the highest since 2004. Now, some financial observers have called on the Bank of Ghana to respond by upping the policy rate to stabilize prices. Reacting to a question on how recent developments will impact Bank at the Ghana Stock Exchange's Facts Behind the Figures session, Group Head of Treasury Philip Dodufin said the bank is observing the macroeconomic trends to avoid bad loans.
Considering the rate at which inflation is moving and also interest rate is moving, you cannot exactly indicate as to when the breaks will be. However, what we are seeing on the market is that it's having a direct impact on the bond market. It's also having a direct impact on the FX side also. However, what we are seeing is a lot of bondholders are now being careful to trade on a short end or to purchase on a short end, not to go too much into the long term or medium term because of the rate at which we are moving. And that's also having a direct impact on JR. And people are also monitoring these two variables. Once the interest rates are moving, customers are prepared to go on a short end to take advantage of the repricing that we are seeing. However, we have to monitor what the regulator will be doing as a central bank in terms of next MPC, what will be the next policy rate direction, and that will also direct what the market will be doing. So these are the few things we'll be monitoring, and we believe that the market is still fluid and it's not stable at the moment.
And where do you believe policy rates go to?
Definitely, they would increase. What we are seeing both on non-food inflation and food inflation going up, the regulator would have to consider all these variables and maybe adjust the MPC the next meeting. So we believe that they will definitely edge up, and that will also influence the interbank market, that will also influence the bond market, and also that will affect the total interest rate markets going forward.
Well, that was Philip Dodufin, Group Head Treasury at Bank, partner and Head of Financial Advisor at Deloitte Ghana. Yalati joins me now to discuss this further. You had the Group Head of Bank there talk about the potential impact of the high inflation on interest rates. How significantly do you think interest rates would be affected by the soaring inflation rate?
Here with British Prime Minister David Cameron.
Can you hear me? Yeah, can you hear me? Yeah, if you can hear me, I wanted to find out how significantly interest rates could be impacted by soaring inflation rate.
Yes. Hello, can you hear me?
I can hear you.
Excellent. Okay, so thank you very much. So the statement that was released with the new inflation figures attributed the cause of the inflation to two main factors, which obviously food inflation and non-food inflation. So in the last 4 months of the year, inflation has averaged over 18.2%. And a significant component of it has been non-food inflation. And the non-food inflation has been caused by some of the indirect taxes that were introduced in 2021 budget. Going forward, we've seen that the effect of the global pandemic, global conflict, and then the cost of oil, rising cost of fertilizer is affecting food prices. And so food inflation is now a key factor, the key driver of the inflation rate that we are seeing. The problem is interest rates will only be attractive, or interest rate will go high to attract savings so as to avoid a lot of cash chasing money. The issue is if the cost of food and the cost of non-food items are increasing higher than the return that people get on their investment, people are not going to invest. People are going to liquidate their investment and use to buy goods and services because the returns on investment is not enough to compensate for any savings that are made. So I think that for now, if you are going to adjust interest rates, the interest rate adjustment should consider any adjustment that will mitigate the impact of the depreciating local currency. So if we stabilize the local currency, we can manage the inflation. Because according to the finance minister, and obviously if you look at the inflation results, significant component of the inflation as we have now is imported. The way you manage that is to mitigate the impact or the effect of depreciating local currency. If the local currency is depreciating, and as a result of imported inflation, then you have to manage exchange rates. So we would rather want a policy that helps to mitigate the impact of imported inflation. And the policy should be directed at stabilizing the local currency. And so I guess if you would have to adjust the rate, the policy rates, what extent we are adjusting should be something that will help us mitigate the impact of the imported inflation.
Right, and well, we've seen the central bank try to do that, at least at the recent MPC meeting. The outcome was an increase in the policy rate, which we expected would ease spending and then obviously have an impact on inflation. But we are not seeing that adjustment reflect just yet. And so the question is it taking too long to reflect? Would it ever reflect?
Yes, that's because of the point I made, that the cause of the inflation goes beyond what we would say can be